Options premium and expiration.
Premium. It is the price that an option buyer pays and the amount an option seller receives. For example, an investor decides to buy a call option for a stock. At a strike of 50 rupees, the investor gets offered that call for a premium of 4 rupees. The investor decides to buy one contract, which has lot size of 100 shares of the stock. The investor would pay 400 rupees. Similarly, if he sells option, then he will receive 400 rupees. Is made of two values, intrinsic value plus extrinsic value. Extrinsic value is also known as time value. Extrinsic value is never be negative. It is always positive or zero. Expiration. The certain date that option contract finished or completed. It may be monthly or weekly.